Welcome to Buy, Hold, Sell. My name's Matthew Kibben, and today we're talking about company profits. The Australian market's just gone through its half-yearly profit reporting season, and there were some big winners and definitely some big losers. And to discuss how things went, we've got Don Williams from Platypus and Ben Rundle from NAOS. Welcome, gentlemen. Ben, we'll start with you. Reporting season was probably more volatile than any other reporting season I can remember.
Yeah.
How did you get through? Did you step on a few landmines or you got through?
I would definitely agree with that. Didn't step on any landmines, but the issue we found is that, so if you look across the broader market, I think everyone's quite aware that it's a low growth environment, and there's a few patches out there, tourism, ageing demographic, a couple of others exporting goods to China which do have growth. The problem is a lot of fund managers and a lot of money was all piled into those stocks. They reported well, but then the share prices came off because it was an overcrowded trade. So that made it a little bit more difficult. Yeah.
Don, did you see it the same way?
Yeah, look, I guess our take on it is that growth stocks did very well in the second half of last year.
Yep.
And our value is taking over. So there's little growth. There's little more. We don't think there's any more upside in some of those growth names.
Right.
So we're transitioning.
They were crowded trades, do you think? The market was lured in by growth?
To some extent, yes, but I think the reality is there were probably more people than we would have expected hiding in those names that were deemed to be safe. And so now growth is just having its inevitable correction from that overvaluation.
Okay, let's take it from there. So after this reporting season, where do you position as far as stocks go for you, portfolio for others, individual stocks? Where do you want to be?
Well, I mean, we're still focusing on quality, and I guess the things that became too expensive, we've either dramatically reduced the position size or we've sold out of them completely.
Right, okay. Ben, we just mentioned the word quality there.
Yep.
There was a lot of stocks you wouldn't consider quality that have had problems over the last couple of years who actually bounced quite hard out of reporting season.
Yeah, that's right. And look, I think it comes back to the same thing that a lot of people were either underweight or short a lot of those lower quality stocks. The results probably weren't as bad as everyone was expecting, and they had a rally on the back of it. So, it has been a tough environment. I agree with exactly what Don's saying in terms of I think the growth stocks for the time being have probably run out of steam, and a lot of people start to play a lot more of the value names.
And is it time to get back into big caps, which were very disappointing last year? Well, the small end of the market had that terrific run, especially the back half.
Yeah.
Do you think it's a switch back into the big end of town?
I don't know necessarily if it's a switch between small caps and big caps. I think it's a switch more into stocks that have been overlooked and show some signs of value, whether they're large or small caps. You're probably finding a lot of them are in the larger cap space, given so the top 20 stocks have been sold off. But if you look at the top 20, it's very hard to find names which you think that you can get excited about. But maybe there's some green shoots and some things have been oversold there.
Don, the biggest loser over the last couple of years has been the mining sector. Anything to do with commodities has felt it really hard.
Yeah.
But in the last little while, through reporting season and beyond, they've rallied quite hard. Do you see they've got a future, or do you think it's limited and we should stick with the industrial names?
Yeah, that's a good question. I think in terms of share price appreciation, I think there is a bit more in it. Look, the macro for commodities hasn't really changed. So we think oil and iron ore, for example,
Both rallied the commodity prices.
That's right, but they're very challenged industries that they both are suffering from oversupply, in our opinion. So even though they're doing a little bit better, I think at some point they'll just go sideways. So our operating assumption is that most, if not all, commodities will go sideways over the course of this year. There'll be rallies and there'll be dips, but I think net commodities won't make a lot of headway from where we are now.
Okay, recently we hit the overall market hit a 20% down from its top about a year ago now. Bear market. What's your feeling? You've had a reporting season. What's your feeling going forward now? You've seen some company earnings. Will it bounce back, or is it going to be a tough calendar year?
Look, I think it's going to be another tough year, and it seems to us that earnings growth is, if anything, is getting harder to come by. I think the growth pulse in Australia, in my opinion, is less than the 3% that the official numbers suggest for the last quarter. So we would argue that we're in an economy that's growing at about 2%, and that's quite difficult for listed companies, especially large companies, to grow. in.
Ben, low growth, we just talked about it there, let's say somewhere between 2 and 3%.
Yep.
But that does mean interest rates will stay low. Does that mean equities can get higher, go higher, grind higher through the year, or is it going to be a tough year?
Oh, look, I think it'll be a tough year as well. I mean, sure, equities look good relative to interest rates, but yeah, I think it'll be a tough year again.
So the reporting season didn't give us a lot of joy, and it could be a tough 12 months ahead.